Interest rates influence borrowing, saving, spending, and much more, making them one of the most powerful levers in the whole economy. Understanding how they work explains a great deal of economic news and policy. An interest rate is essentially the cost of borrowing money, expressed as a percentage, and equally the reward for saving or lending it. If you borrow, the interest rate determines how much extra you pay back. If you save, it determines how much you earn. So interest rates set the price of money over time. Because they set that price, interest rates shape behavior across the economy. When interest rates are low, borrowing is cheap. People and businesses are more inclined to take loans, spend, and invest, which tends to boost economic activity. When interest rates are high, borrowing is expensive and saving is more rewarding. So people tend to borrow and spend less, which tends to slow activity down. Interest rates act like an accelerator and brake for the economy. This is why interest rates are so closely watched and why central banks often adjust a key rate to influence the economy, lowering rates to stimulate a weak economy, or raising them to cool an overheating one or fight high inflation. Their decisions ripple out to the rates on mortgages, loans, and savings that affect everyday life. For example, when interest rates fall, a family finds loans cheaper and decides to borrow for a home. When rates rise sharply, they hold off and save instead, rates steering their decisions. Economic conditions, policies, and measurements vary from one country to another, and they change over time. Economists themselves disagree about causes and cures, so check what applies where you live. The main lesson is simple. Interest rates are the cost of borrowing money and the reward for saving, acting as a powerful lever. Lower rates tend to encourage borrowing and spending. Higher rates tend to slow them.